Welcome back to Everything Money. In this video, we will update you on Google stock. You will learn how to read financials from our software. We will show you our 8-pillar process, and we will move toward what you should be paying for Google using our stock analyzer tool to help predict the future of this stock price. If you want to trade Google at a quicker pace, Mo at the end of the video will show us the charts and trends for trading. You'll learn how to trade it. But first, why should you watch us? I bring your questions about Google, this mammoth company, to a couple guys that operate over $100 million portfolios that include real estate, multiple businesses, and stocks, and they will help us develop a mindset of potentially investing in a company like Google. Paul, I know we all love this company. Give me your thoughts about this incredible company. Go ahead.
Thank you, Uncle Seth. First off, guys, follow us on Instagram, Everything Money Investing, and then also follow our 3 personal accounts because
we're cuddly and adorable.
We are cuddly and adorable. So guys, this is our Everything Money software, which I'm sure you've heard about. If you haven't, you're living under a rock. Let's go to our 8 pillars tools.
You're from Iraq.
I am from Iraq.
Okay, go ahead. 8 pillars, Google.
All righty. Look at the max chart of Google. Well, look at that. $50 back in 2004. All right, guys. Google is a $1.9 trillion company. That's trillion with a T. First pillar, we want the 5-year PE to be under 22.5. This 5-year PE is 53. That's an X. Now remember, guys, faster growing companies like Google should have a higher multiple. So let's not worry about the 59 PE quite yet. Let's worry about that when we do our stock analyzer tool and look at revenue growth. Pillar number 2, we want the 5-year return on invested capital greater than 9%.
ROIC.
Yep. On our software here, our exclusive software, it's listed right here on the main page, 12.8. That is a check mark.
Very nice.
So 1X, 1 check, no dividend on Google, but look at this free cash flow. 5 years of $35 billion, last year of $65 billion. Good start so far, even though the PE is high.
The 3rd pillar is revenue growth. We like to see, of course, how much money they're making, which I'm sure is absurd, Paul.
Yes. So we go to the income statement on our exclusive software, scroll down a bit. Revenue. 5 years ago was 107. Last year, 239. Check mark there. Yeah, it's over doubled in the last 5 years, Seth. Look at 10 years ago, $46 billion. $46 billion. And this is all ad stuff, guys. The 2 largest search engines in the world, Google, then YouTube. Who owns YouTube? Your friend, the Goog. So whenever you type anything in, I just saw a great YouTube commercial the other day, by the way.
Tell me about it.
Have you seen this commercial? I saw it on the on Sunday watching football. It has like 3 people, they're all average people. Now one's an astrophysicist, one's a vet or something like that. And said, where did they get to start? YouTube. Like that's when they started learning about the things they liked.
I'll be darned.
Yeah, it was a good advertisement. Pillar number 4, net income growth. So again, income statement on our exclusive software, we scroll down. 5 years ago was $21 billion. Last year, $70 billion. Now, look at this though, Seth. They doubled their profit in the last year. I have to think in the last year, online advertising really skyrocketed. Wouldn't you think?
Yeah.
Because of COVID, et cetera. All right. Point number 5.
Your companies use Google? You're advertising with this?
We do use Google in some regards. We focus on Facebook only because I think Google advertising is great for if you have a specific. I am trying to get people who are searching for, like, for example.
What about the roofing company you have?
Yeah, we don't have a roofing company. We have a property restoration business.
Restoration,
But for example, for you, when somebody goes to Google and types in wedding photographers, Cleveland, Ohio, you'll want to advertise for that exact phrase so that people see your ad on there. Absolutely. I think Google's much better for not impression ads, but pay per click, where it's like somebody's going there specifically for this. They're typing into Google, brothel in Cleveland, Ohio. Boom.
You do that often. Yes. Shares outstanding is pillar number 5. We want to see if Google's selling off shares.
So guys, shares outstanding is a silent killer. We want to make sure they're not increasing their shares, which is therefore diluting you as an owner and decreasing your percentage ownership of the profit and revenue. So we scroll to the very bottom of the income statement. 5 years ago, they had 693 million. Now they have 665. Check mark there.
Oh, it's going down. I
will say this though. Buying back shares when you're an overpriced company is not a good thing. That's not a good allocation of capital. But we'll get into that later. But so far, listen, I'm glad they're not diluting us necessarily, but buying back shares, who knows?
Pillar number 6 involves their debt. Paul, tell us about it.
All right, guys. So just like your personal life, companies with less debt are going to stick around longer. And that's the name of the game. We don't want a recession to hit or some sort of trouble in the company that they can't service their debt, all of a sudden they go to the creditors and there's bankruptcy. So what do? I go to the main page of our exclusive software. I go to the 5-year average free cash flow. I multiply it by 5, and I get $175 billion. 35 billion times 5. I want their long-term liabilities to be under 175 billion, okay? So then I go to the top of our exclusive software to the balance sheet, scroll all the way to the bottom, 41 billion. We wanted under 175 billion.
Wow, quarter
This
of that.
company has, so, I mean, if you look at this balance sheet,
pay that
guys.
off?
What was that?
Why don't they just pay that off?
I don't know. Good question. Their total cash on hand,
Maybe they need to build their credit, Mo.
Maybe so.
Yeah.
I do have a question for you.
but really quick.
After we're done.
So their $184 billion cash pile and total liabilities of 102. So they can pay off all their debts with a stroke of a check. What's your question?
Why don't we ever see companies with zero debt, zero long-term debt? Like if you're a company like Google, why even bother having debt? Like and I ask because you never see it.
Good question. Listen, I'm not saying I don't know. I can come up with 1,000 reasons why they would.
Course.
Rates are so low now.
Yeah.
Go take out a 10-year note to investors because you don't know what's going to happen in the future. Might as well take cash in today.
Mm-hmm.
Maybe you're overpaying today, but you might need it in the future. I don't know. Yeah. I don't know. Maybe it's for banking relationships. Like, hey, let's go put this debt out there. Yeah. That way the banks like us. I don't know. There's so many other reasons to do it. I really have no idea.
Like we never see zero there, even
so
though
like for our operating business upstairs, apart from the real estate, we like to have zero debt. Yeah. We have zero debt except for the real estate.
Right.
Like everything money is zero debt. Right. I just prefer it that way, but I also I couldn't care less about bankers. If a banker came to me and said, "Hey, Paul, if you take debt with us, we'll do work with you," I would tell them to shove their chair up their asses. I wouldn't care. So I don't know.
Are you surprised that the stock price hasn't split down to make it a little more affordable for us normal folks?
Well, affordable, yes. I mean, the stock is $2,800. That's a lot. A 10-for-1 split still makes it $286. A 20-for-1 makes it $140. But I kind of like it when companies keep it high. So,
Pillar number 7, Paul, is free cash flow growth. We want their free cash increasing. I'm certain it has been.
Free cash flow is cash from operations less your capital expenditures. You can do one of 5 things with it. Buy back shares, pay dividends, pay down debt, invest in yourself, make acquisitions. Mm-hmm. So we go to the cash flow tab at the top of our exclusive software, scroll a little bit down to the middle, cash from operations less your capital expenditures. Your Uncle Paul created this line here, so it provides the math easy for you. 24 billion, 65 billion, check mark there. Their free cash flow has almost tripled in the last 5 years. Our final metric is we want to take the 5-year average free cash flow of 35 billion, also written right here, multiply it by 20, that's $700 billion. We want the market cap under 700 billion. Now remember, guys, this isn't set in stone. This is a starting point. A faster growing company should have a higher multiple, but we want to start somewhere. Just like the average historical PE is 15, that doesn't mean you only buy 15 PEs. If a company is growing fast, like Google is, you should pay a premium. But right now, the company is 1.9 trillion versus 700 billion. That's a massive X. Now, let's go to the 8 pillars tab where we did all this math for you. For those of you going, man, that's a lot of work. Look at this. 6 check marks and 2 X's. And where are the 2 X's? Valuation. So what's our goal here? Our goal here is now to use our stock analyzer tool. And here's why, guys. The future is unknown, but every investment is the present value of all future cash flow. We have to make assumptions on that future. When we talked about how we don't know if this PE and price of free cash flow is reasonable or not, if the company's going to grow 50% a year for the next 10 years, this is very reasonable. I'm buying the company all day. If it's going to grow 1% a year for the next 10 years, I ain't touching it.
Big diff.
Right. So we have to sit there and use the stock analyzer tool to input our assumptions. And let me make it bigger so it's easier for you guys to see. Input our assumptions and determine, and it'll tell us exactly the price we should pay based on those assumptions. Okay? So, first things first. You can pick number of years of analysis.
50.
We can do 1 through 20. I'm still going to do 10, but I think Google's a company that's going to be around for Google does a great job of making sure people go there. It's simple, it's easy. Listen, I always tell people in tech, it's hard to be it's easy to be thrown to the side in tech. I mean, what's it going to take for for the masses to stop using Google? They own YouTube. They own Google. Google is the verb. You just Google something. You don't ever, I don't remember the last time, what was that?
You don't search it. You Google it.
You Google it. Man, it's going to be tough. Doesn't mean it's not going to happen, but it's going to be tough to, I think they have 2 billion people who use it a month. Anyhow, so first things first, revenue assumptions. Uncle Mo.
17, 19, 21.
17's your low.
Yeah, I mean it's big, but I also look at it like
What's the revenue going to be?
competing
What was the
with them?
revenue
What's
last
the revenue
year?
going to stop?
240 last year.
It would take $1.2 trillion
In 10 years.
in 10 years.
I mean, if there's going to be a company that gets to $1 trillion
Remember
revenue,
though, Mo, and this is, by the way, I want you guys to understand, like Mo and I are both value investors, and I usually disagree with Mo's revenue assumptions. My goal is to be conservative, and then from there, now what's conservative? When I see 10 years of 19.6, I don't think conservative is 17. To me, conservative is 10%.
That big of a difference, huh?
Yeah, I do, because I look at, again, does it mean they're not going to grow at 17%? No, it doesn't mean that. But to me,
I guess I look at companies like this and Apple and what more can they do? And I think they have more opportunities out there. And that's why I don't.
yeah, but more opportunities, you're right, but how do you move the needle? If I told you right now Google's going to start a company that did 10 billion in revenue in the next 2 years, I'd be like, sick.
It's not going to do anything.
It increased their revenue by 5%. That's nothing to me. Now, I'm going to look at this and say, okay, what's the user growth of Google over the next 10 years as the world becomes more? I mean, they're, all these things.
I mean, do they even get Google over in Asia and stuff yet?
I don't know how it
In
works over there.
Africa?
Let's do 10, 15, and 20. Because look at 20% revenue growth.
They did 240 this year.
That would take them to 1.5 trillion in revenue. The biggest company in the world right now is $500 billion. That'd be triple the biggest company in the world 10 years from now. Mo, I know I could be wrong, but I look at going, if our goal is to be conservative, this isn't conservative, in my opinion. But I'll still put it on the high side. But more to show things. Profit margin.
Now, I have to think that stays around that 22 number. That's a pretty consistent number, right?
I would think so. 20, 21, 22. Free cash flow margin, probably
thing.
same thing.
I'm interested to hear your PE.
10 years from now when the company's ginormous. 14, 16, 18.
Okay.
What do you think?
I thought you were going to go like
12, 14.
10, 12.
No, because they have the
lower.
brand. They have the moat. To me, that's a huge moat.
Yeah.
And guys, desired return, 12.5%. And the reason being is if you can invest in an ETF and get 9 or 10%, if you're going to do all this work, give yourself a margin of safety. Get yourself 12.5%.
Get you some.
Analyze. Guys, the only place where it makes sense to buy the company right now is assuming the 20% revenue growth. So if you believe that Google's revenue will be $1.5 trillion in 10 years, buy the stock all day right now. If not, you got a problem. See, to me, I've always said Google's in the low thousands. And it shows right for me. Because I want to buy good companies at great prices. Or great companies, I want to buy great companies at great prices. Or good prices I'm okay with. This is not a good price.
So in general, Paul, 10 years ago, their operating revenue was 34 billion. They're now at 230. So it's what is that? Not even 10x. It's a 7 or 8x.
Yes. And now we're talking about doing another 7x 10 years from now. Is it possible? Sure. Is it probable? No. So I don't think the next 10 years is going to be equal to the last 10 years.
If you're interested in getting this software, if this speaks to you, Paul will tell you how to grab it right now.
All right, thanks, Seth. So guys, we created the software because our users kept requesting, how do we do our own research without waiting for you to make your own videos? So we spent lots of money, created the software. You get everything you already saw in the video. You get all of this content right here, which includes 30 years of financial data, access to Seth, Mo, and I. You get it all on your mobile phone. This entire website, everything you've seen on your mobile phone. You get the stock analyzer tool. You get real estate calculator, retirement calculator, all the extra additions. You get our 8-pillar portfolio, exclusive daily content, 2 or 3 videos a day from Seth, Mo, and I on separate topics. But most importantly, guys, you get access to over 6,000 people are current active users of our software. They're in a chat that's very organized with multiple rooms about different topics. You can talk to them about all your investment ideas, tell them your ideas. They give you feedback. You have actual discussions because most of the people are like you out there who didn't have others to talk to about investing. Now you do. This is wonderful. It's only 90 cents per day. Less than a cup of coffee, guys. 90 cents a day. If you can increase your returns by 1 or 2% a year, or decrease your losses by 1 or 2% a year, this will lead to hundreds of thousands, if not millions of dollars in extra wealth when you retire. 90 cents a day, guys. 2 ways to sign up. Everythingmoney.com or Patreon. The benefit of everythingmoney.com is you get no sales tax charged to you yet because we're not big enough. So sign up, you get access within minutes, 90 cents per day.
And if you want to trade Google at a quicker pace, I said quicker, Paul. Quicker pace. You can join, it's Mo, right? You can join Mo in the Bid and Ask Nation, and he'll trade this puppy with you. Show us how it's done, Mo.
So, with Google, it's a great long-term play because it's one of the fangs. Now, let's pay attention to moving averages right now. These are all-time highs up here. So we're on top of all 4 major moving averages. The volume is getting pretty light. And if you look over the past month, there's only been a couple of days where we've hit average volume on Google. So I would say, come over here, long-term chart, just keep following it. Right now is not a time to add, but it is a time to take profits if you're in it because you have that cross right there. And this doesn't mean exit. This just means take profits and see what's going to happen. If this thing can move back to the top and take out and make new all-time highs, listen, if the market goes higher, this is going to be the thing that drives it higher. It's one of the FANG stocks. But if you don't want to do that and you want to be more comfortable just getting in and out on a daily basis, come over to a swing trading chart, grab these little increases in price that you can while you're waiting for some big trend to happen. So there's different ways that you can go about doing this. You don't have to just go in and sit in it for a very, very long time hoping that it moves. You can go in and play a 1 to 5 day trade. So if you want to learn these rules, come over and join me in the Bid and Ask Nation. You get the Trading 101 series, which is the rules that you will follow. The Employed Trader series, which is 6 stocks that we can trade on a long-term basis and also a swing trading basis. My monthly seminars that I do, and a Discord community of 900 plus people that all want to trade just like you. Come and join me.
That is our take on Google. At some point, this stock will fall into our sweet spot. And if it doesn't, then guess what? You just don't invest in it. We want few great plays in our life, few great stock picks. And this might not be one of them, but a great company we'll always love. So that's our take. Fondle a thumbs up. Join our community. I'm certain you'll love it. And we'll see you next video.